Today, we're going to talk about one of the most common strategies in trading, overbought and oversold. But more importantly, we want to take you outside of the usual way of thinking and apply this strategy to all markets, sideways and trends. Overbought and oversold are common because they generate enough trading signals to be friendly to short-term traders, especially in the sideways market, seems to be able to give more accurate entry conditions. Here, perhaps many traders will compare them to divergence. The advantage of divergence is that it provides a reliable stop loss. But in the sideways market, there is no divergence. The market can also reverse. And to the trend market, even if the divergence appears, the reversal may not be able to form. From this point of view, overbought oversold general use much stronger. There is a bias towards this strategy when looking at overbought and oversold, especially when looking at historical trends. This bias comes from artificially sifting for signs of success. But in many cases, indicators hit the upper and lower boundaries well before prices reverse. For the first use of overbought and oversold, as is commonly known, the indicator touched a certain range, can be extremely left to open the way. There is only one point of attention, need to be very strict control of the stop-loss ratio. Next, and more importantly, is the way overbought and oversold are used in a trend, which is the exact opposite of the first trading strategy. That is, indicators reach overbought level, go long, indicators reach oversold level, go short. This problem can be well illustrated by two cases. The first is Eurist. At this position, we can see a relatively clear oscillation interval. The upper and lower boundaries are shown in the figure. So within that range, you see that overbought and oversold played a role. Oversold bounced back, oversold fell. However, after reaching this position, the indicator also reaches oversold level, but as mentioned before, since it is not within the volatile market, but a breakout, the RSI reading here reaches 22. However, the exact opposite should be done, and the indicator is oversold and should be shorted. You can see that after the indicator is oversold, it keeps getting oversold and diverging. But it still doesn't work. It keeps going down, and that's a pretty big drop. So it's the exact opposite of that. When the price is out of the range and the indicator is oversold, you short it. The second example is also very typical. Bitcoin. Let's look at the 4-hour chart. Again, in this interval, after this position has been broken, you can see that in the previous volatility market, the indicator is also relatively effective, hit the bottom boundary and then rebound. And then at this position, when this negative line appears, you can see that it's once again out of the range of its original oscillating range and into a new plateau. So here the RSI reading is 26.55, but again it's a very steep drop, and in the next 4 hours, it's a rapid drop of $10,000. If you switch to a smaller cycle, it will be more obvious. After this position is broken, you can see the strength of the oversold indicator is very strong, but it did not have a significant rebound, but all the way down, after oversold, and more oversold, the indicator reading all the way from the 20s to the lowest only below 10. So this is the second use of being overbought and oversold, which is very useful in a trend, which is to do the exact opposite when the price is out of its range.